Zach Hurwitz here with the VWAP.com. Just doing our VWAP roadmap or resource guide, the PDF that we just released, Q&A for everyone who might have a question or two about this wonderful indicator that, many years ago kind of transformed me into the trader that I am today. All right, with the core concepts, this is something that I notice a lot of other traders when they're teaching VWAP, they don't really try and find the insight that would make VWAP unique. They treat it like another moving average. They kind of assume it's just another piece of technical analysis. And because this is something that I've really focused on and specialized in for, gosh, depending on when you count my start with VWAP, nearly a decade, better part of a decade. The things that jump out to me that make VWAP unique are kind of hidden under a very simplistic display, right? Like VWAP looks like a moving average, but it's not a moving average, and it doesn't behave necessarily like a moving average. So the most important point of separation is what I write here about cumulative versus periodic. I know these are kind of dorky academic terms, but VWAP being cumulative from an event, where most other technical analysis is just periodic, looking back a certain number of candles. So you guys are probably familiar with this from simple moving averages, exponential moving averages, an RSI, MACD. These all have a length or a look back period, a number of bars from the right of the chart going backwards that it performs its analysis over. VWAP, on the other hand, works from the left to the right, starting at a critical event. So for our purposes, for intraday VWAP, that's going to be the market open, 9:30 a.m. Eastern. And it goes forward in time, building that average over however many candles have elapsed during the day. You guys probably remember me saying this on the Chat with Traders podcast, if you guys have heard my appearance on that. But the human brain doesn't think about things in any periodic sense. Instead, we ask questions that are based on events cumulatively going forward, such as, how was your day? We don't know how long that person's been awake, doesn't really matter, and we would sound like a robot if we asked, how have you been for 8 hours periods? So the best thing we can do is relate experiences from critical events going forward. You know, hey, Jim, I haven't seen you since the Christmas party last year, rather than, Jim, I have not seen you for 172 days. Because VWAP is cumulative from an event, that means we don't have to worry too much about a lot of the usual details and the idiosyncrasies that most technical analysis kind of requires. So if you've ever had a debate with someone about maybe an RSI, and you said, well, I think the RSI is really good. They say, oh, I think it's really bad. And you kind of argue for a while and then realize you're talking about maybe an RSI over 14 periods, 14 bars, and maybe they're talking about an RSI over a much shorter look back period. So even though you're talking about the same indicator, you're dealing with two different variations. And that kind of discretion that traders have access to, sometimes it can really screw you up, because it's your job to figure out what the right settings, the right details would be for that indicator. And that leads me to the next main point here. VWAP isn't susceptible to changes in type, length, or time frame. So as we were just saying, a simple versus an exponential moving average over the same period, maybe 20 bars, can look somewhat different. How do you know you're using the appropriate moving average? How do you know you're using the appropriate settings on some given indicator? All of that discretion leads to different variations that a trader can effectively screw up. So the beauty of VWAP is that it does not change based on the time frame of your chart, meaning a 1-minute chart, a 5-minute chart, 15-minute chart, 30-minute chart, 60-minute chart, you're still looking at a volume weighted average price. Kind of a weird analogy, but I'm going to use it anyway. If you were trying to figure out the average apple weight from your apple orchard, and you weighed all individual apples one at a time and then calculated that average, Would that give you a different average if you had weighed the apples in groups of 5 or 15 or 30 or 60? No, because we're talking about the same apples grouped differently. Part of what's exciting about VWAP is that simplicity of how it's displayed and that there aren't many settings for the trader to mess with. It belies a really sophisticated and pretty complicated calculation that's going on under the hood. So it's neat that it does allow that stuff for us, so we don't have to worry about, am I looking at the right time frame of chart? And obviously, that's not the case with things like moving averages. A 5-minute 20 simple moving average is very different from an hourly 20 simple moving average. Now, this one is a bit trickier. I'm going to ask for just a second, and I do want some feedback on this. When you guys read this core concept about VWAP as a magnet that is either attracting or repelling, did that resonate with you guys? Did that make sense, or was this a bit confusing? And feel free to say, Zach, I have no idea what you're talking about. I know you're an analogy guy, but magnets, dude, like what are you talking about? Nice, Kevin. Makes perfect sense. Awesome. Thank you, Christian. Use VWAP to determine a trend, but the magnetism is really a nuance that I didn't. And you're right. We don't know when it will hold or repel, but that's because we haven't gone through the details of determining which environment we're in. And obviously, like I say here in the second sentence, identifying the prevailing market style either towards or away from VWAP. That's your main objective. Not so much, am I going long or am I going short? The question is really, are we moving or are we not moving? Are we trending or are we chopping around sideways? I think it's really easy to fall into the binary of, well, I just got to get the direction right, long or short. But if a market's going sideways and not breaking out, then really, or breaking down for that matter, then really both are incorrect. So I kind of reframed how I use that central benchmark of VWAP as my reference point. Rather than worrying about an absolute direction of long or short, I'm relating all of my trades to whether or not we're moving closer towards the center of the chart or outward and away from the center of the chart. I think a lot of people have in the past described VWAP as a magnet, but they only describe it as an attracting magnet. It's kind of funny that the analogy is perfect. You just have to develop it a little further and say, not only can it attract, it can also repel. When you fit the market to that framework of it's either attracting or repelling, it's not necessarily just one or the other. That explains a bit of confusion, the duality of the market. Like Tuan was saying, we don't know whether it'll hold or repel. We do have a couple key indicators and I don't want to call them tricks, but methods for determining what style or type of market we are in. And then finally, VWAP has inertia about it. So momentum, or a tendency to keep doing whatever it's doing, whether remaining stable and flat or sloping. When you think about it, this is another major separation between VWAP and common moving averages. Because moving averages are typically shorter term and very responsive to changes, that means you're going to get a lot of signals, which can seem appealing, I understand, to an active trader. But the problem with getting a lot of signals is how credible are those signals? It's like the boy who cried wolf. He's going to give you a lot of signals, but half of them are going to be lies, right? By contrast, volume weighted average price has a stickiness to it. When it starts trending in a direction, that's requiring so much money traded in that stock in order to move the average. It seems, shouldn't say it seems, it is significantly more credible because to reverse that or to change the direction of VWAP or even to make it stop sloping is going to require quite a bit of time and quite a bit of money, which adds to the credibility, the believability of the signals we're getting from volume weighted average price. One of the things you'll hear me talk a lot about is the volume weighted average price's slope, just the intensity or rate of change of the VWAP at any given moment. That tends to be a main overarching signal for the likely future direction of the market. And the only other little comment I think I'll give on this element is we don't tend to see that same back and forth, up and then down, and then up and then down that we see with moving averages with VWAP. We're not likely to get a strong reversal from an uptrending VWAP to a downtrending VWAP. It's much more common that we're going to have that middle ground of going sideways. So let's say we have a strong upsloping market for the first hour. The next move of the VWAP is probably not a sharp downslope. That's might be what we would expect from a periodic or a moving average. What a VWAP is probably going to do is flatten out and go sideways and digest that new price action for a bit. So later in the document, we start talking about event-driven averages. Event-driven averages, or anchored VWAPs, as other people have called them, are launched from points of the chart that are not necessarily the start of a trading day. As you can see here, this applies to both intraday and daily charts. So we can create either very short-term VWAPs launched from a critical area, maybe a local low at 11 o'clock Eastern. So, we have a strong sell-off in the morning, and then maybe the market makes a significant low. Similarly, on the daily chart, we can launch it from, as I described here, meaningful, fundamental, or technical events. A question I definitely got, I'm going to try and look on my document here. Yeah, how do you use VWAP for swing trading, or what type of events do you usually anchor your VWAPs on? And the example I think was Fed Day. That's a great example. The key is just to launch VWAPs from crucial events. Detecting which events and which VWAPs are valid is something that we're going to cover in a lot more depth during the group coaching session each month. Not trying to sound too secretive or that I'm not giving it away. There's just not enough time to cover how we would evaluate whether an event is significant. But I will tell you also that there are the usual suspects, like what I've mentioned, that are a good starting point. I've had traders before who've looked for significant gap events, geopolitical news, a Trump tweet. There's all sorts of events. The reason we would want to use something like a VWAP from a critical event is, again, it goes back to the cumulative nature. If we said, hey, Jim, how have you been since you started that new job? What we're effectively asking is a cumulative question from whenever this guy, Jim, started his new job. So if, for example, picking a random comparison here, let's say the CFO of a company was arrested for accounting fraud. That would be a major event for that stock. We'd want to know from that event going forward, how have traders reacted or responded to that information? And it's tempting to say, well, couldn't I just look at a 200 moving average on a daily chart? And that would include the area you're talking about, Zach. Well, it would, but it would also include a lot of data that isn't really relevant. What we're hoping to see is from a critical event, how have traders responded? You can actually see here on the daily chart, what we've done is we've anchored it to an earnings date. And look at the support given multiple times that we come down to that level. Trailing an average price from a key event gives you a definition of trend level, an area that probably shouldn't be challenged if the market is to continue in the direction it's been headed. Oh, Chaz also asked, are there weekly VWAPs or monthly ones? Yes, absolutely. I think the problem with using a calendar basis for when and where you launch your VWAPs is that kind of assumes that the calendar is meaningful. So for example, maybe VWAP over the course of a week. I think that's pretty plausible. It's a trading week. We've got a weekend in between. But a monthly VWAP? How do we know that someone is watching the VWAP for the month of November? It's a little more plausible that on a short-term basis, if someone receives an order that they have to fill on behalf of a client, and maybe they have all week to accomplish it, it needs to get done by Friday at the close, they may be watching the weekly VWAP in that context. But a monthly one or a 1 year VWAP, I'm not so sure about. And that's not trying to discount its validity. It's just being cautious that there's no guarantee that looking at a 1 year chart and launching a VWAP from exactly a year ago is necessarily going to be meaningful. If something important happened roughly or exactly a year ago, absolutely. To that same point, I will point out that a year-to-date VWAP, so launching that from January 1st or the first trading day of January in a given year, can be helpful because I do know there are fund managers, institutional traders who look at year-to-date performance, certainly. Do we consider pre-market a micro VWAP? Good question, AJ. I don't know if I would consider that a micro VWAP because it would start before the, let's say, typical VWAP at 9:30 a.m. Eastern. That is a good question, though. It's a separate VWAP than the one we're typically talking about, which I call intraday VWAP or the normal VWAP. And we will talk a little more about pre-market and post-market in just a couple minutes, AJ. So good question. Interesting. So this is a comment. He says, notice that anchoring a VWAP at the previous major high before the latest high seems to be more accurate. So it really is idiosyncratic to the chart. That's part of what makes this kind of difficult, is that there is not a guarantee you can simply go launch a VWAP from earnings and that will be applicable, or from a major high. What we're going to look for in evaluating or validating VWAPs is the respect shown to that VWAP and its deviation bands, as well as the quality of the launch point. So depending on how much volume occurs at a major high, the magnitude of price movement off that high. Very cool. So it seems like this clicked with a lot of traders as well. And these are just a couple examples. Remember, we're trying to put together a really condensed version of something that I've spent, like I said, 8 years thinking about. Now, standard deviation bands. Standard deviation bands. This is something I am surprised to find that a lot of traders, even large successful traders who have used VWAP for a while, don't routinely apply to their charts. I think the best way to describe them from kind of a practical standpoint, they give us additional dynamic support and resistance in a way that we wouldn't have otherwise if we were only using a single line, a single benchmark like the VWAP. So you can kind of imagine a chart that's trending upwards, it's moving away from its volume weighted average price. If we only have the VWAP that we can trade with, a huge problem here is we're kind of stuck waiting for the market to retreat back to the VWAP. That's our only effective entry. What I've found to be really helpful is particularly the 1 and -1 standard deviation divider. You can actually see that here on the charts. The white dashed line on either side of my volume weighted average price. We've kind of annotated it down here on the example charts. What's beautiful about standard deviations is they, as the name implies, standardize market behavior. So regardless of how big the stock is, or how small the stock is, or how volatile or not the stock is, standard deviation bands allow you to kind of quickly gauge the context of the market. All right, they give you statistical context for what is normal. Maybe I shouldn't say normal, it's a loaded statistical word. What is typical to expect from a chart. So standard deviation bands help us by better understanding how much volatility we can expect, as well as they give us tactical, technical entries and exits. Bill asked a good question here. Are the standard deviation bands in these examples anchored along with the VWAP? So in these examples, they are starting at the same point and calculated starting from the same point. I'm only going to be crystal clear here. These are normal intraday VWAP examples on this page, meaning it's a 9:30 a.m. start ends at 4 p.m., just a normal market day. So I wouldn't exactly call these anchored VWAPs, but yes, I mean, to directly answer your question, yeah, the standard deviation bands start at the same time as the VWAP, and they do move in effective lockstep with the VWAP. So you can actually see, and I apologize, I know this is really small, but I assume you guys have the VWAP PDF guide and you can pull this up on your own. As the VWAP is declining throughout the middle of the day, the standard deviation bands are being dragged downward along with it. During a rampant expansion, however, one thing you'll notice is that even when the upper standard deviation band is moving in lockstep with the VWAP, the lower standard deviation band is kind of being pulled in two directions, right? There is expansion of the size of the deviation band over time, but it's also being effectively pulled higher by the rising VWAP. So that's why the lower standard deviations on this trending chart don't seem to be as responsive or moving in as lockstep with VWAP's rise. It's because for every bit that is pulling the deviation bands higher, because VWAP is moving higher, the size of the deviation bands are getting bigger and bigger and bigger. You might have been asking also, because there's some shading on the charts here for the first 30 minutes. That's not pre-market. That's actually something I created to dissuade traders from attacking the market or using VWAP in the first maybe 30 minutes of the day. What I found is that a cumulative calculation tends to be really responsive and really fast, but not very credible or believable until it's become established. So I usually give it about 20 or 30 minutes, and that lets the kind of violence and volatility of the opening range suss itself out anyway. The example I've given in the past, when I was a freshman in college, I remember the first couple weeks I was at school, my mom would, text or call and say, "How are your grades? How are your grades? How are your grades?" And I would tell her, "Well, I'm getting all A's right now, but I'm 2 weeks into my first semester. So maybe this isn't representative of how well I'm going to perform for the entirety of my 4-year collegiate career," right? So early on in a cumulative calculation, and I relate a GPA, a grade point average, and a VWAP because they are quite literally significance weighted cumulative averages. So they're very similar in that sense. The first couple weeks of college may not be representative, right, of what the student is gonna do for the rest of their time. In the same sense that the VWAP in the first 30 minutes may not be representative of what you can expect for the rest of the day. Got another question here, give me just a second. This is a good one. Does the change in slope of the VWAP and standard deviations move the same, or do they move at different speeds? So you can actually see, this is kind of what I was just referring to about the two different forces acting on a standard deviation band. They will move with the market's direction. So that's one force, right? When the VWAP is upsloping, the standard deviation bands, even the ones on the bottom, will be pulled higher. But the separation or the difference that you're referring to, Chaz, is going to be because the deviations themselves get bigger and bigger and bigger over the course of the day. So you can see here, I'm kind of drawing the size of the deviation. You can see it growing as the volatility increases. So they will move at slightly different speeds, but that's just because of, again, the two forces acting on the market that are in different proportion to one another. The net of those two forces acting on each other is what's going to create the difference in standard deviation movement speed, if you will. One other good point that we made here, these are two dramatically different sized stocks. The one on the left is Amazon, the one on the right is AMAT. With the standard deviation values of $8.50 and 87 cents, those are two very different sizes of standard deviation, but look at how the charts maybe don't look similar, but have a similar framework applied to them. So that requires no tweaking, no calibration from us, the trader. We don't have to get it right. We just simply apply the calculation and look for similar or related patterns. It's neat because if we were using, let's say, dollar distance away from VWAP, some stocks routinely move $5 away from their VWAP, like Amazon maybe. And some stocks would never move more than 50 cents away from their VWAP, and that's just based on the size of the stock. If you do the same thing with percentage, maybe you say, well, I'll use 1% away from the VWAP. That's going to be my divider line for what's far away from the VWAP or what's pretty close to the VWAP. Well, the problem there, again, is some stocks are very volatile and tend to move 5% every day. And other stocks would never move more than 1%, or it's unlikely that they would. So we needed something that was going to be objective and kind of standardize, no pun intended, as the name implies, it was standardized market behavior across different or disparate stocks. And again, I keep going back to this. It's intuitive, it's objective, it's a calculation we don't have to perform, and it makes for great familiarity or kind of repetition of what we're looking at, so that we don't end up having to, here's that word again, idiosyncratically, kind of unique to each chart. We don't have to calibrate our studies or our indicator. It saves a ton of time, and it removes a lot of potential for screwing up by setting the moving average to the wrong length, or getting the wrong time, or tweaking the calculation in some way. And believe me, I'm a trader too, y'all, and I was a developing trader back in the day. I remember what it felt like to think, if I just changed this just a little bit, maybe it would work better. Maybe I could tweak it a little bit. You kind of have to get away from that tendency. It's easy when you've got a lot of options for how to change your analysis. The fact that VWAP is kind of one fixed concept removes a lot of that temptation. I think here we just go through, another example of that kind of rapid expansion, if you will. Look at how condensed the deviation bands are here at the start of the day on SPY. And when it really breaks out to the downside, breaks down, I should say, you can actually see the deviation band width going from microscopic, only 25 or 30 cents to several dollars in size as the day develops. And when I'm talking about the size of the deviation bands, obviously what I'm referring to is the distance between the VWAP and the one deviation band. And just to be clear, that's going to be the same amount of distance as between the -1 and -2 deviation band. You could think of standard deviations as a unit of measurement. It's kind of weird to think about it that way, but each stock has its own typical amount of movement away from the VWAP. And that can develop and change, and it typically grows over the course of the day. If you look at the second example, so this is Boeing instead of a breakdown day on SPY, you can actually see here how the market is somewhat contained between the deviation bands. We have a very flat volume weighted average price during that period of time. If you kind of contrast that with a strongly sloping volume weighted average price and expanding deviation bands, those are the two different kind of types of day that we're experiencing. Great point. Jeff actually just chimed in. I'll give him credit here. He pointed out, look at the volume surge during this breakdown. You can actually see here at the bottom of the charts a significant volume creating the massive expansion in deviation bands. If you contrast that with what we see over here, when we break down below the deviation band, what's the volume doing? I mean, it's decent, but it's not the same massive burst we got as the market really collapsed under the, under to a new low. And so what we look for is we look for not only slope, but confirming volume. We want to see participation from the big boys who are actually going to move the market. I think that's fairly intuitive, right? We all know that larger traders control the market in a way that we, independent retail traders, do not. So it's not so much about what we think or suspect is going to happen next. It's really what's being evidenced on the chart, right? Who's voting with their wallets. And with that, I think, yeah, we could go through a little more about standard deviation bands and developing a strategy, but all this seems to be, I think, pretty straightforward. I know we've got a bunch of other questions that I still got to get to. So why don't we do this? I'm gonna keep this chart up for the meantime. This is a chart of SPY today. What I'm gonna do, if it's all right, is I'm gonna start rolling through some of these pre-submitted questions and answering them pretty quickly. So, question from Chaz. Is there a way to measure slope of VWAP with respect to the horizontal axis? Absolutely. So one of the indicators that's included in group coaching is something I call the VWAP aspect. That's the indicator down here at the very bottom of our charts. It doesn't look like very much right now, but what you can see here is that there's a burst of green slope when we are uptrending. And then as the market shifts to a very flat and kind of sideways, contained, non-breakout mode, the indicator just basically goes to sleep. I don't think the question itself was, can we measure slope with respect to the horizontal axis? I mean, obviously we can. The question is kind of how do we measure it? And when you think about this also, I understand not everyone needs an indicator to detect upslope versus downslope. I think that's pretty obvious, right? We can see that with our eyes, whether a VWAP is upsloping or downsloping. What this indicator does that I think is really helpful is it shows changes in magnitude of slope. So you can see here at the beginning of the day, we have a really strong burst of slope as VWAP is nearly vertical. And then as it starts to flatten out, the indicator's intensity, whoops, I could probably draw a better line than that. The indicator's intensity is declining over time, foretelling a little bit of a waning of intensity as we get out of that first hour, the kind of high volume period. And that foreshadows a bit of what we see here, a breakdown from being outside of the 1 deviation band, above the +1 deviation band, to breaking down beneath it, and a quick retreat immediately to volume weighted average price. I don't know if you guys noticed, but look at how different this part of the market looks relative to the first hour or so. We have a strong trend and a sloping volume weighted average price. And then as the VWAP flattens out, again, kind of foretold from this declining or waning slope indicator, that leads to a more sideways market. You guys might remember me saying when we have an uptrending volume weighted average price, we don't expect a downtrending VWAP to be the next move. We would actually more expect it to go sideways and digest the current price behavior. Question from Chaz here. So now that the slope is essentially zero, when would you enter a position intraday? Without going too much into detail, just because I know we're on limited time, I would say that a flattening volume weighted average price is much more of magnetic attraction to the VWAP rather than repulsion. So though we do get a bounce off the VWAP and effectively coming back in a bounce here, we get close, we don't exactly touch it. I would argue that the safer trades are trading nearer to the extremes back towards volume weighted average price, kind of a reversion effect. And this is obviously something we're going to go into a ton more detail. I've actually got 4 primary price patterns, trade types, if you will, that we're going to cover. That's all included in group coaching, of course. Next question is from Javier. He says, I'm using a Bollinger Band and VWAP crossover trigger using the midlines only. So I'm shorting below and going long above. You're now saying that the other way around, maybe long below and short above. So what am I missing? So that's something that we covered with the idea of magnetism that I was just referencing. It obviously is a bit confusing that there isn't just one interpretation of the VWAP. But using some of the tools and tricks and indicators that we've built, it makes it a lot easier to determine or discern what type of environment you're in. So I think what's key about your question is that you recognize there are 2 interpretations. Either we are trend trading in the direction of the VWAP, or we are counter trend trading back towards the VWAP itself. Good question from Jason here. He says, what's the difference in VWAP with commodities, with stocks, and with Forex? So stocks tend to react the best. That's where you're going to get a lot of large, consistent institutional orders. And that translates obviously to larger traders who are watching the VWAP as a benchmark and are trying to get the best average price on their position relative to the average price for the day, aka VWAP. So I absolutely think that stocks are a VWAP playground, particularly large cap stocks, S&P 500, NASDAQ 100, liquid ETFs, that kind of stuff. Commodities have more externalities, crop production, inventory reports, commercial clients who are hedging meteorological events, stuff like that, and also a nearly 24-hour trading cycle. So you're going to get a much longer VWAP and therefore a slower VWAP. The bigger and longer a cumulative calculation goes on, the less any new piece of data has impact on that average. For Forex, which you also asked about, we can't actually apply a VWAP to a Forex, spot Forex chart, I should say, simply because we don't have centralized volume to work with. Like if we actually knew the amount of volume, so to speak, it's kind of weird to say this, the number of dollars, because that's literally what we're trading with spot Forex. If we had centralized volume, then we could apply a VWAP. There is a workaround for that to approximate a VWAP on Forex, but it's pretty rarely applied. For anyone who's curious, just so you know what I'm talking about, instead of using centralized volume, we would assume that every candle on the chart has an equivalent volume. So you could say 1 share. What that does is it gives us the benefit of VWAP's cumulative calculation without the kind of dynamic element of volume weighting the average. So it's not going to speed up or slow down when more volume is traded, because again, we don't know that. But it's going to give you a slow cumulative average across the entirety of the day. So you get some of the benefit of VWAP, but maybe not all. Do you find that even today, the VWAP is used as the benchmark amongst large institutions? Absolutely, absolutely. It is, I would argue, the most common benchmark. And there are, let's say, some pitfalls when using VWAP versus TWAP versus another benchmark. The beauty of it, though, is its commonality. So if you say to someone, the VWAP for the day, they know what you're talking about. And there's no question as to what the calculation is. If you told someone, hey, let's use the 20 simple moving average, well, what time frame are you talking about? And did you mean simple or exponential? And are we sure 20 bars is a fair average? There's a lot of other, like I said, nuance to other technical analysis that can lead to kind of miscommunication. So it's like telling someone the gravity on planet Earth. We all know what that is because we all live on the same planet and we all experience the same gravity, right? Tuan asks, for futures, do you trust the cash open more or the 24 hours, the kind of like all-time VWAP? And what about stocks? So pre-market, post-market too. I think for futures, I tend to trust the cash open or regular hours VWAP. The 24-hour VWAP can matter, but like I was saying a minute ago, it includes so many more candles. It can only serve to slow down the responsiveness of the VWAP anyway, and the volume is typically a little bit lower. For stocks, I don't also typically use pre-market or post-market data, as I'm more focused on the higher volume, like regular trading hours periods. But naturally, if news or earnings or some major event occurs before market open, I will absolutely include that on my charts. And again, back to the beauty of a VWAP cumulative calculation, VWAP will automatically adjust to fit that new data in. So it'll start at the beginning of pre-market rather than starting at the market open. Do you use fib retracements or common moving averages with respect to VWAP or crossover of the VWAP or other moving averages? I personally don't. I do believe lightly in Fibonacci retracements. I would acknowledge that I've seen them work before. I don't think they work with the consistency that I would want from my own trading system. I think the fact that you are drawing a Fibonacci retracement, and I don't mean you, Chaz, obviously, I mean the fact that a trader has control or discretion over that leads to a lot of problems. Are we anchoring it to the highest high of the candle or the close or body of that candle? That can make a small difference. Do we look at only major Fibonacci's, or are we drawing them, 3 to 5 on every intraday chart? It can get very confusing, and you're almost kind of carpet bombing an area with support and resistance, looking for opportunities. So I'm not as much a fan of fib retracements. And then using VWAP in conjunction with moving averages, I'm not as opposed to that as you might think. I recognize that the value of a normal moving average is that, like I was saying, it's responsive. It's going to change quickly when price starts moving. So I think it will give you a quick signal. However, I'm never going to use that in conjunction with, let's say, a crossover, like a moving average crossing over a VWAP. I don't think that necessarily has too much significance. Like, I think you're going to get more value and a faster signal from simply looking at price patterns with respect to VWAP anyway. Anchored VWAPs on which time frame is most effective. So rather than time frame, I think you're asking probably about the width or the size of the chart. So when I say time frame, to me, that means the size of the candles, like a 1 minute, a 5 minute, 15 minute, 30 minute, hourly. I tend to find that shorter term VWAPs are more powerful since they're more recent and they're occurring off of an important relevant event. So an example would be between like 1 and 20 days ago. The market does have history and memory, but it tends to have a much better recent memory. Makes sense, right? And obviously beyond 20 days, you're looking at launching VWAPs from major events, usually on a daily chart. Here's a related question too. What longer timeframes do you use to apply to either your intraday or swing trading? So there are 2 main timeframes that I use for intraday trading. I tend to use the 5-day 1 minute and the 20-day 5 minute. Now, those aren't essential that you've got to get it exactly right, but I tend to tell people a 1 minute and a 5 minute chart are pretty much what I stick with. Occasionally for swing trading, obviously, I'm going to go to a higher time frame and a much wider chart. So I'll be looking at maybe a 90-day, 30-minute chart. And the key here, why I'm never just looking at 1 day at a time, is because I want to see context and behavior, or where I need to be launching longer term VWAPs. And please, guys, it is totally fine to tweak that. So if you're looking at maybe a 10-day chart instead of a 20-day, because that's all that will fit on your current monitor, that's perfectly fine. The key is to give yourself both as much detail, so that's short-term bars, small bars, and a lot of context. So that's a big stretch. As wide a chart as you can, as many days included as you can reasonably fit on the chart without losing a lot of that granularity. Question from Rahul. How do you use VWAP for swings? What type of events do you usually anchor your VWAPs on, like Fed day? Right. Yep, and like I said, the key is to launch your VWAPs from crucial events, but detecting which events and which VWAPs are valid is something I obviously can't cover right now, but I absolutely cover in group coaching. And you're certainly on the right path, like you had suggested, Fed days, major events. The problem, I think, with just assuming every Fed day is going to be important, or every earnings is going to be important, every major high or low is going to be important, you're going to end up with a ton of VWAPs on every single chart. And so evaluating VWAP is really going to be a crucial thing we go over. Should you plot deviation bands on longer term VWAPs as well? Yes, absolutely. Standard deviation bands and all of the same principles that we're going to address in even the first session of group coaching will apply to any VWAP, regardless of its size or duration. So some of the stuff we talked about with slope, standard deviation bands, the 4 primary trade types that I'll cover, all of that's going to apply to a micro, a normal, or a macro VWAP. Now, obviously, kind of naturally, since you're dealing with larger VWAPs, the deviation bands are going to be much wider and therefore will be interacted with like significantly less frequently than a shorter term VWAP and its deviation bands. You can kind of imagine that. If we're looking at a VWAP from a year ago, its deviation bands are pretty far apart, and therefore it's going to take a lot of price movement just to even interact with those, as opposed to, you know, a normal intraday chart where we tend to hit the VWAP several times. We tend to test or explore deviation bands as well. Another question I saw just come in: VWAP most useful for earnings reversals? I probably would need to know a little more to be able to answer that directly, but I mean, earnings is a common, certainly high volume launch point. Sometimes VWAP seems to act as trustworthy support and resistance, and other times price moves right through it. Why does this vary? That's a good question. It all has to do with how much defense is being offered at the VWAP. So if buyers, for example, don't think there's going to be higher prices imminently, they're probably much more likely to wait and let price drop below VWAP to a real steep discount. So let's look at this the other way. The only reason to defend or buy it at the VWAP is if you think the current average price is going to look like a discount later in the day. So that kind of means, like, when it goes up a ton over the rest of the day, you're going to look back and say, why was I waiting for a discount? I knew I had to buy that thing. Why didn't I just buy it at the average? Why was I so arrogant as to think it was going to drop all the way and give me a perfect entry? So the goal is really to distinguish, when are we in a random market that's kind of not observing or respecting the VWAP versus a non-random or trending market. We need to know when to avoid or be cautious with a chart, rather than simply saying long or short. Sometimes neither is the answer. And when I say neither, I don't mean literally you can't go long and you can't go short. I'm simply saying there's no overwhelming directional trend. Here's another good one, kind of related to the moving average question from before. Do you use VWAP alongside other indicators or just by itself? VWAP is great for telling you where a trade will occur, but maybe not necessarily when. So it's like a location indicator, not a timing indicator as much. Something like the RSI can be helpful at detecting divergences, areas where the stock is going to wane in its intensity or kind of flatten out. But we also have other indicators, like I described before, the VWAP aspect indicator. We have multi-day VWAPs as well, additional credible support and resistance. I gotta be honest, I am a VWAP purist. I'm someone who has had so much success focusing and simplifying, kind of streamlining my charts. I really am trying not to add too many other things to, I don't want to say confuse me, but to make this more difficult than it is or has been. Here's a good one. So how does VWAP relate to volume profile? I do get that question a lot, actually. Both methods are going to display volume in kind of a unique way. Volume profile is showcasing at what price each segment of volume is occurring, like literally displaying volume by price at which it traded, rather than volume by time, which is what we see at the bottom of the chart. Volume profile also highlights the price segment at which the most volume is traded throughout the day. I think it's called the point of control, the POC. By contrast, VWAP is kind of condensing all of that information and volume into a single benchmark line, which represents the average, not just the highest occurring area of volume, but the actual average. So essentially, VWAP is the mean, and the volume profile point of control is the mode. If you guys remember, Algebra 1 or whatever that was, the mathematical terms for the average and the highest occurring data within a set of data, or the most frequently occurring data point. To determine the change in overall trend, are you looking at VWAP over, say, 20 days perhaps? I'd probably use a slightly shorter term one, maybe a 5-day volume weighted average price. If I was looking for intermediate or shortish term trend. 20 days I think would work, but might also be a bit long. Just my gut reaction to that. Cool. Steven says, yeah, using volume profile and VWAP together can be really powerful because they tell you two different, disparate, but related elements of where people have traded. And when you think about that, what we're really getting at, guys, is where people have felt confident to commit millions or billions of dollars. So instead of just saying volume, we should really think about it like money, when people are committing or transacting money in the market. So that's all the questions that I've had submitted so far. And we had a lot more than I expected, and we had some great ones. Why don't we do this? I'll stick around for another couple minutes, and if any more questions come in, I'm happy to answer them. If you guys have any questions whatsoever about what's included in group coaching, anything that I do, my background, my history, trading psychology, I really am an open book, and I'm sure you guys got the sense from the PDF that we offered, from my Chat with Traders interview. I absolutely love doing this. I love connecting with other developing traders. It actually makes me a better trader, and it is personally fulfilling in a way that working alone really doesn't get me. It's fun to trade, don't get me wrong, but it's not fulfilling in the same sense as seeing that, like I described it, I think, eureka moment in others. Why don't we do this? We'll pull up a couple charts and take a look at them while I'm letting people throw some more questions in. And we'll make sure we wrap up in the next 5 or 10 minutes, just so everyone can get on with their evening. Here's ConocoPhillips from today. Actually, look at that. Some really nice respect of the deviation band multiple times. And here's that waning intensity that we talked about with the slope indicator. So that's foretelling a bit of a, I don't want to say a breakdown, but a pause, a de-acceleration or deceleration, whatever the right word is, from this kind of rampant breaking out above the 1 deviation band. I'm sure everyone can kind of see this, but there's additional highlighting when we are above the 1 deviation band or below the -1 deviation band to emphasize or remind traders that it's really aggressive in its behavior. Run through a couple more charts. Let's see what else was interesting today. Ooh, McDonald's. My goodness. All right, so nice gap up with the market, retreated under VWAP, and then immediately rejected at the volume weighted average price itself, and then sunk below that deviation line. Look at how aggressive of a sell-off that was. Barely comes back to the dev band and resumes. You can actually see in here there are a couple more attempts to breach that deviation band, almost all of which failed. Now again, here we've got that waning intensity of the slope indicator, and that does not immediately mean we're going to get some massive reversal or rise. What this means is that the intensity of the market is kind of falling off, almost like wind dying down on a calm day. And you can see here that the market began going sideways rather than continuing its aggressive sell-off. Wow, talk about a VWAP bounce. My goodness. So strong uptrend holding outside of the 1 deviation band, even right out of the gate. Literally, I think spent 1 candle under VWAP all day. Strong move up, fails at the deviation band, and that foretells a bit of a reversion back towards volume weighted average price. Now, some people may be tempted to say, well, so I need to go short and try and cover at the VWAP. I would argue that because we have such an uptrending volume weighted average price, even if it flattens out, it doesn't exactly. There we go. Even if it flattens out, you're still in a rising market, right? And there are buyers who are eager to get aboard at or near the volume weighted average price. It's kind of fascinating. Look at the rejection that we saw at the deviation band over and over and over. One important note to make about this, these are all what you see is what you get, meaning there's no like retroactive fitting to price action. So part of the kind of admiration I have for VWAP is that it's constantly being tested by having to calculate this stuff on the fly. There's no curve fitting or going back after the fact. It's all in the moment. So it's exciting to see when we get that kind of support or resistance behavior, even if it's not a trade type. That's something that we can maybe use to take profits, like Stephen was asking. Yeah. PayPal, another blast off at the volume weighted average price. Anytime you see large traders defending a stock at its volume weighted average price, you have to ask yourself again, why would they be doing that? Other than if they knew or strongly believed that there was a good chance that the market was going to be much higher over the course of the day. And in fact, if you told someone at the end of the day, hey, I bought at 102.75, well, the market is 2% roughly higher, you would have gotten an excellent entry on this retreat back to the VWAP. Retreat before resuming a strong trend, I should point out. And even here, support at the deviation band. And obviously, we could go into multi-day VWAP examples as well. We're just already 25 minutes over the end time, so I'm probably going to wrap it up here. But I will tell you this, whether you choose to sign up for group coaching or not, my goal is to kind of popularize VWAP and get it, like I said, in the hands of as many traders as possible. Even if all you do is add this indicator to your charts yourself and begin observing some of the principles that we covered in this webinar and in the roadmap PDF that we sent out, I think your trading will definitely improve. It will give you a reference point against which you can judge the performance of a market. I hope you guys all have a wonderful evening and great luck in the markets and some good experience with VWAP.